What if I told you that everything you've been taught about debt is wrong? We're told to fear it, to avoid it at all costs, and to pay it off as quickly as possible. But for the world's wealthiest people, debt isn't a burden. It's their single most powerful tool for building unimaginable fortunes. Today, we're pulling back the curtain to reveal the secret strategies the rich use to turn debt into a wealth-generating machine. And stick around, because the final strategy is so counterintuitive, it'll completely change how you see money forever. First, let's get one thing straight. There are two types of debt: bad debt and good debt. Bad debt is what most of us are familiar with. It's the high-interest credit card debt used to buy things that lose value, like fancy clothes, expensive dinners, or the latest smartphone. It's a consumption trap. You buy something you can't afford, and then you pay a premium in interest, making you poorer over time. This is the debt that keeps people stuck in the rat race, working just to pay off their liabilities. Good debt, on the other hand, is the secret weapon of the wealthy. Good debt is money you borrow to acquire assets that will grow in value or generate cash flow. Think of it like this: you're using other people's money, usually a bank's, to buy something that will make you more money. The asset you buy pays for the debt and then some, leaving you with pure profit. It's not about what you own, it's about what you control. Let's dive into exactly how they do this. The most classic example is real estate. A wealthy investor doesn't save up $1 million to buy an apartment building. That would take forever. Instead, they might put down 20%, which is $200,000, and borrow the remaining $800,000 from a bank. Now, they control a $1 million asset. Let's say that building generates $100,000 a year in rental income. The mortgage, taxes, and maintenance might cost $80,000. That leaves a $20,000 profit, or cash flow, in their pocket each year. But here's where it gets brilliant. That $20,000 in profit on their initial $200,000 investment is a 10% annual return. If they had paid all cash, their return would have been much lower. They used the bank's money, or leverage, to magnify their returns. As the tenants pay rent, they are effectively paying down the investor's loan. The investor is building equity in the property without using their own money, and over time, the property value itself is likely to appreciate. So, they win in three ways: cash flow, loan paydown, and appreciation. This is the power of leverage. It's like using a long lever to lift a heavy rock. Your own strength is limited, but with the right tool, you can move mountains. Debt is that financial lever. The rich understand that their own capital is finite, but the amount of money they can borrow from banks is vast. By using debt, they can control a much larger portfolio of assets than they could ever afford with their own cash. This accelerates their wealth creation exponentially. While the average person is slowly saving, the rich are rapidly acquiring income-producing assets using the bank's money. But real estate is just the beginning. The same principle applies to business. Do you think successful entrepreneurs fund their massive expansions entirely out of pocket? Rarely. They use business loans to fuel growth. They borrow money to build new factories, develop new products, or expand into new markets. They do the math. If they can borrow money at a 5% interest rate and invest it in their business to get a 20% return, they are essentially printing money. Every dollar they borrow generates a net profit of 15 cents. The more they can responsibly borrow and invest, the faster their company and their personal net worth grows. This is a fundamental mindset shift. The average person thinks, I need to earn money to buy things. The wealthy person thinks, I need to acquire assets that earn money for me, and I can use debt to acquire those assets. They see debt not as a personal liability, but as a business tool, a raw material for building their financial empire. Now, let's talk about the tax advantages, because this is where the game gets even more rigged in their favor. The interest you pay on good debt, like a mortgage for a rental property or a business loan, is often tax deductible. This means it reduces your taxable income. So, not only is the bank's money helping you generate income, but the cost of that money is subsidized by the government in the form of tax breaks. Let's go back to our real estate investor. That $80,000 in expenses, which includes mortgage interest, is deducted from the $100,000 in rental income, so they only pay tax on the $20,000 profit. Meanwhile, a regular employee gets taxed on their entire salary before they can even think about investing. The rich are legally minimizing their tax burden, freeing up even more capital to reinvest and acquire more assets. It's a virtuous cycle of wealth creation. But what about the risk? This all sounds great, but borrowing huge sums of money must be dangerous, right? Yes, and the rich are masters of managing that risk. They don't just borrow recklessly. They have strict criteria. First, they only borrow for assets they understand inside and out. They are experts in their field, whether it's real estate, a specific industry, or the stock market. Second, they focus on cash flow. The asset must generate enough income to comfortably cover the debt payments and all other expenses with a healthy margin of safety. They stress test their investments. What if vacancies rise? What if interest rates go up? They plan for worst-case scenarios. Their goal is to create a situation where the debt is self-liquidating, paid for by the asset itself, not by their own labor. This is the key difference. If you take on a mortgage for your own home, you are the one who has to work to pay it off. If you take on a mortgage for a rental property, your tenants pay it off for you. One is a liability that drains your income. The other is an asset that builds your wealth. Now for the strategy that feels almost like a cheat code. It's called buy, borrow, die. This is the ultimate technique used by the ultra-wealthy to build generational wealth and pay almost no tax. Here's how it works. First, they buy appreciating assets like stocks, art, or real estate. They hold these assets for years, even decades, as they grow in value. Let's say they buy $10 million worth of stock and it grows to $50 million. If they were to sell that stock, they'd face a massive capital gains tax bill, potentially millions of dollars. So instead of selling, they borrow. They go to a bank and take out a loan against their $50 million stock portfolio. Because the loan is secured by such a valuable asset, they get a very low interest rate. The bank might lend them, say, $10 million. This loan is completely tax-free. It's not income, it's debt. They can now live off this $10 million, spending it on anything they want, without selling a single share and without paying a dime in taxes. Meanwhile, their $50 million portfolio continues to grow in value, likely at a rate higher than the interest on their loan. Their wealth is still compounding, even as they spend borrowed money. Then comes the final step: die. When the person passes away, their heirs inherit the $50 million portfolio. And here's the magic. Thanks to a rule called the stepped-up basis, the original cost of the asset is stepped up to its market value at the time of death. This means the $10 million initial investment is forgotten. For tax purposes, it's as if the heirs acquired the portfolio for $50 million. They can then sell some of the assets to pay off the $10 million loan. And they won TONE capital gains tax on that massive $40 million appreciation that happened during the original owner's lifetime. The entire tax bill is legally wiped clean. The wealth is passed on to the next generation, virtually tax-free, and the cycle can begin all over again. This is how the richest families in the world not only get rich, but stay rich for generations. They have mastered the art of using debt as a tool for leverage, for tax efficiency, and for transferring wealth. They've shifted their mindset from scarcity and fear to abundance and strategy. They understand that you don't get rich by saving your pennies. You get rich by controlling assets, and the fastest way to control assets is by intelligently using other people's money. It's a completely different financial language, but it's one that anyone can begin to learn. So, the next time you hear a financial guru telling you to cut up your credit cards and pay off all your debt, remember that there's another side to the story. There's a world where debt isn't a four-letter word, but the key to unlocking financial freedom. Understanding this difference is the first step. But no one expected this simple idea to create such a massive gap between the rich and everyone else. Thanks for watching. If this video opened your eyes, hit that like button and subscribe for more secrets of the wealthy. What other financial myths should we bust? Let me know in the comments below. See you in the next one.